Well, I'll kick off the session now. This is our 10X talks. So for those who have not been part of this, these are the monthly virtual education series where we bring together either a single leader or a panel. Like today, we have a panel discussion of 4 really fantastic founders. And essentially, they share a lot of their learnings, insight with the rest of the community on any hot topics of the time. And share their advice and their wisdom with us. So it's a fantastic time to get together. Nice, quiet. You can ask questions. So we really like it. I'm Bob Reed. I'm the director of programming at Starter Studio. I partner with Paul Coulter. He's the president of Priority Concepts Group, and he and I together are hosting these events. Ken Hall, who typically host these, said, Bob and Paul, can you help me out? Well, we did more than help. Now we got it and we're running with it. And we're happy to do that. And we'll be looking into the rest of 2024 and into 2025. So today we're very, very grateful to have 4 founders with us, and they're going to share their perspectives on the benefits and drawbacks of bootstrapping versus venture capital and what the experiences are with both, and each have a kind of interesting story to share with us. So we will also have Q&A. We'll be watching that, so please pop those in the chat. We'll have that at the end, but if we think Paul and I go, hey, that's a cool question to ask, no problem. We'll be asking that, so please do that. All right, I'll kick off now with introducing the panelists. I'm going to ask each of them to do their elevator pitch. Give us that 1-minute pitch and include when you were founded. Would be very, very helpful. But tell us about who you are and what you've done. Okay, we'll start off with Wayman.
Hey, well, good morning, and thank you, Bob and Paul, for the invite. I'm Wayman Armstrong with ECS, Engineering Computer Simulations. We are a software development solutions provider and training services firm for the Department of Defense. We have been around for 27 years, have approximately 100 teammates and employees and contractors, and we have leveraged over the last 27 years over $100 million in government-funded research and development to provide as far as for applications. I would say that we are someone who is leveraged as far as Bootstrap for about 8 years till we got to reach in, bringing in some business associates as angels who've still been with us 19 years later with not looking for an exit yet, but it's coming up, I can tell you that. And during that time of bootstrapping, I went 38 months without getting paid and incurred $322,000 of credit card debt. And that's when it was a lot 20 plus years ago. So that's our story.
Ooh, fantastic. Thanks, Wayman. All right, Chin, tell us about you.
Hey, folks. Good morning. My name is Chin Ma, founder of Chirp Technologies, Orlando-based. We started in 2021. The mission of our company is to serve home insurance companies and their insureds to prevent non-cat claims and help people have healthier homes. So if you're thinking, why the heck is my insurance premium going up so high? Well, it's because they pay a ton of claims that they need to basically recoup for their losses. We help them prevent claims. If you're wondering, why is my relationship with my insurance company so transactional? They either renew me or non-renew me, and I barely get to have a conversation with them or have a relationship with them. We work with them to guide homeowners to prevent key losses and help people have healthy homes. So about 34 employees, was a part of the Starter Studio program back in 2021 under Bob's leadership, and happy to be here.
All right, thanks, Jim. All right, Sean.
Hi guys, my name's Sean Whalen. I'm the co-founder CEO of HopSkip. We're a 5-ish-year-old B2B SaaS marketplace that eliminates the manual, tedious work that's traditionally involved in getting a large-scale business event or conference sourced and booked at a hotel. So we work with 4 different types of customers, all completely doing different jobs to be done on the platform. Think of us as like 2 different SaaS tools connected through a marketplace. We just raised a $3 million seed round about a month and a half ago. We were bootstrapped for the first 5 years or so. So I've kind of lived on both sides of the fence, and I'm happy to be part of the discussion today.
Okay, thanks, Sean. And Abby?
Hey everybody, my name is Abhi. I'm the CEO and co-founder of Fluix. We're based out of San Francisco. We help data centers save 40% on their energy cost. We do that with using an AI autopilot technology. Essentially, we control the AC, lighting, water, IT systems inside these large industrial facilities. Uh, I'm a second-time founder. My first company was in the cooling space. So I've been in the data center industry for about 10 years. It was completely bootstrapped, and this company is venture backed. We're a team of 5. We've raised about a 600K friends and family, and we're about to close a $2 million seed round as well. So happy to share a little bit about our story as well. Thank you.
Okay. Terrific. Thank you. Thank you. All right. First question for the panel. I'll ask all 4 of you. Basically, all founders start out bootstrapping, right? They have to decide, okay, where do I go from here? What happens after I bootstrap? What are my options? So at what stage in your startup journey were you faced with a decision to either continue bootstrapping, and maybe you did that several times, but then say, all right, now it's time to raise cash? What was that kind of point that had happened, and what was the motivation? What was happening to you at that point? So Sean, why don't you start?
Sure. Yeah. A couple different things come to mind. I mean, I was very much in the mindset where I never wanted to be an entrepreneur, found a company to be on the front page of TechCrunch like that. I don't think that is the right reason to start a company. So raising venture capital in the early days really wasn't an option in my mind. We definitely tried to raise venture capital before we ended up raising it, which again was, as short as 2 months or so ago. One of the things that made me confident, though, Bob, to answer your question directly on timing, is around product market fit. So I think one of the beauties of bootstrapping for so long and then deciding to bring on some institutional capital is a couple things. One, the team learns how to be super capital efficient, and we kind of have baked in our DNA like that scrappiness. I still have anxiety sometimes, like burning now some of the cash, size of the cash that we're burning. And I want us to always, even as we, are a venture-backed company and could potentially raise additional venture funding in the future, I want us to have that baked in our DNA as we continue to scale the company, that, to still act like we're bootstrapped. Product market fit, though, is, I think, just to wrap up on this, the biggest confidence indicator for me to say, okay, now's the time to bring on some VC money, because we know we have something that works. We know who to target, how to message it, and it's just pouring fuel on the fire.
Okay, good comment. And I know from an investor standpoint, bootstrapping is a good thing, and how long you do it, how you manage it. Yeah, it gives them good signals of, if I'm cutting you a check, what are you going to do with my money? How are you going to manage it? So good, very, very good point. Okay, Abhi, same question.
Yeah, so the first company, it was, and I know a lot of the other entrepreneurs here have bootstrapped as well. I was working a full-time job using that money to fund inventory for our hardware company, cold calling customers in long lunch breaks while I was working for that larger company. And I had product and inventory in the trunk of my car. I would cold call manufacturers and then go do site visits during these long lunch breaks. So that's how the company was funded. I think the decision to go to VC was twofold. One was, hey, what is the scale of what I can do this, right? And if it's something that that you want to take this company into a unicorn status. And I know a lot of entrepreneurs say that, and maybe a lot of people don't don't try to back it up, but there's 2 things that happen is, one, can you repeatedly do that action and get revenue? And 2, if you want to take it to a unicorn status and you want to have those words, just so everyone knows, a unicorn status is a company with $1 billion valuation. It's going to be very difficult to do so without funding. And your growth rate to do those repeatable actions is very difficult without funding. So although there have been amazing stories of companies that have bootstrapped, you got to understand your growth rate and repeatable action. And you got to understand if, and maybe it's not the right fit, right? Maybe you create an incredibly successful company without funding. But if you want to go try to attain that unicorn status and the business has the metrics to do so, it makes sense to go after funding.
Okay, great, great. And Chen, same question.
I think my journey is very similar to Sean's. When we started, it was bootstrapped. And then like Abby was working at a large company. I was a Deloitte management consultant at the time. And yeah, we just figured it out. I remember when we were looking into building our core technology that includes like a mobile application, proprietary AI, a huge workflow platform that serves insurance companies. I probably thought about quoting it myself as a Deloitte management consultant, and I was like, yeah, I'll probably take about $5 million. And you look in your pocket and you're like, wait a minute, you have like 40 grand to basically spend on this. So you're just like, how do I figure out the discrepancy? And I think the level of scrappiness to figure that out, whether if it's selling through your car or just being absolutely paranoid about costs, is something that is a great rite of passage, right? I always think that like getting money early is probably not the right thing, unless if you just have some crazy world-beating technology and have a pedigree of doing it like your fifth time.
Right.
When we came into our journey about funding was, we got it live, right? And, by live, I mean, we had 2 environments and we launched a $1 billion insurance company on a test environment, not recommended, but that's what we had to do. But we were successful. We promised efficiency gains, we promised cost reduction, and we were working with the CEO, so he was very gracious at the time. And it worked. And so that kind of was the product market fit component. And, as we were going through the process, that CEO basically said, hey, listen, like I invest in companies. I mean, this is the best proof in the pudding. Are you guys thinking about raising a round? And he ended up helping us lead a round. I think like what I learned from that experience, I think there's like rules of the road that's really interesting. And I'm actually very curious about what my peers hear about as well. But I'll give you one, and we can probably share as we kind of continue to guide through this conversation. But, I never realized, 2 things. One is, yeah, you have to like understand what the venture capital company or any investor is looking to do, right? Like, surprise, like they want a significant ROI in their investment. And so learning the language and learning the multiples and learning all the like general constructs of what it takes to generate an ROI on a capital investment is really important. And one good rule of thumb that you should apply is like, let's just say you raise $2 million. Your plan that should be very deliberate is like within 18 months to be able to generate like $2 million in ARR, right? And so like that capital should basically allow you to be able to generate like repeating income or revenue in your business that basically achieves that goal, right? Under punch and you're kind of below target, above, and you're just like, pretty awesome. So those are the kind of things that like, I think going through the process, we learned. And it was constantly like just updating the notebook around, oh, got it, right? Like investors care about this. But that product market fit component for us was absolutely key to trigger us to go and say, hey, we can put some fuel on there.
All right, thanks for sharing that. I have to get you in to do one of our cohorts, Jen. That's perfect. Perfect example of, how do you evaluate that? And also, what am I getting myself into? I'm bootstrapping. I'm now getting into venture capital. What are the expectations of those folks? Obviously very different than saying, gee, I need a car loan. I need 40, 50 grand for this new car. And you go into a bank, a completely different set of circumstances. Okay. And Wayman, we'll hear from you.
Sure.
And I know you went through this a while ago, so it might be a little different.
Well, I did. First of all, I tried to raise dollars unsuccessfully. No VCs looked at us as we were going from the .com into the .bomb era. And I had several fellow friends who'd raised some VC money, and they were just shut down. They were closed down, or how they were looked to survival of the fittest going forward. And I knew that also I'd use dry powder, keeping the firm alive going back. And so our credit wasn't great. So we won a large contract going through after 8 years in business. Our credit line, I was going to say, was 50,000 here locally. What else could I do? I went to Huntsville, Alabama, who understood the technology space better. They went ahead and gave me a $250,000 credit line. My wife used to always, joke, why do our checks of public say Mass, Alabama? I said, hey, babe, they're the only ones who'll fund us. You go where that money is. And then as we doubled in size, I believe more firms die from indigestion than starvation. We could not meet that. So after striking out before and raising dollars, I look now and I think I'd be targeted. I'm going to look at fellow entrepreneurs who've been successful, who want to pay it forward, who've had that. So I targeted 3 gentlemen who I'd built a relationship through that time, one in San Diego, one in Kansas City, and one in DC. I went and pitched all 3 of them, and then they came on board and invested with us at the time, and they are still with me 19 years later. One of them had sold his company during that time. He invested in 7 other firms, and 5 years later, we were still the only one that was vital and still active and growing. And I appreciate everybody's, points have been made here. I think one of the things that people forget, so much of it's relationships and character. I mean, I like to say, when we pitch a client, what doesn't say up there, we've made every mistake known to mankind and then some, but we've learned from it and we're still here. And I think that matters as you're going out in the relationships you're doing. And all of these folks we had done work with. And so, and everyone would tell me, I've never invested in one of the firms I've worked with before. You're the first one. Well, there's got to be a first for someone. Hey, if not us, who? And so that's how we took the attitude, and I went across and pitched them.
Fantastic. Yeah. And very, very good points. As we work with venture capitalists too, usually the first thing they say is, I'm starting a 5 to 10 year relationship. Yours is even longer. Do I like these people? Do I want to work with them? And then we advise founders too to say, do you like these investors? Are you imagining working with this person, and this team for the next 5 or 10 years? You really have to give it a lot of thought. All right. Thank you. Thank you for sharing that. I'm going to ask some more questions. I may just pick on 2 of you instead of all 4, but we'll love to get your perspective on these. So second question, how do you balance the need for capital with the desire to retain your equity and hold on to as much as possible and that decision-making power? How do you balance that out? Because you're going to give up something. How do you balance that out? Sean, I'll ask you.
Yeah, one of the things that I think 2 folks said earlier that really resonated with me, and I should have brought up on my part, was funding via your day job. So I started HopSkip like probably 3 or 4 years behind the scenes before our official founding date. And I had a nice paying corporate job that I literally used to fund the business for years, and worked obviously at night and on the weekends. I think one of the ways to think about kind of retaining control versus getting the capital you need to grow is you got to think of it in a couple different facets. One, I mean, in my mind, it's always get profitable, right? Because if you get profitable, a lot of these stresses go away. You have capital coming in, you're not burning cash, and you don't have, a drop dead date. I also think, though, there is value in, partnering with a venture partner, and they're going to hopefully bring to you more than just capital as well. So having a trusted advisor as a partner that can help grow the business, as long as they're not taking the majority of the business away from you, I think is something that makes a lot of sense. And you never want to give up in any round. And this is what I've always learned, been told, and also believe. Like, you got to make sure, depending on kind of how your equity is allocated across the founding team, you're not selling ideally more than 20% in any round, and then the founders always maintain control. So you're going to be required to form a board of directors as well once you receive VC money. And you want to make sure that that board of directors, excuse me, retains control and decision-making rights for the company.
Okay.
And that there's a good proportion of, not unweighted VCs versus founders.
Okay. Thank you. Thank you. Yeah, very, very, very good advice. And some of the complexity too that you enters into the scene as you start to raise money. What's this thing called the board of directors? And oh, I have to be a C corp. And so you're starting to make those decisions. And what all does that mean? So thank you. Chin, same question for you. Balancing the need for capital with decision making and holding on to more equity.
Yeah, I mean, I think if you guys, for those of you that are founders, if you haven't listened to this podcast, I'd highly recommend it. It's called Founders, and it's by this guy named David Senra.
Yeah.
And it's fascinating because, I think as a high growth software entrepreneur, we typically lean on the side of like capital, fuel. And then the interesting balance of this podcast is they have both examples that are equally balanced. So, you have your like hyper capital efficient, never give up an ounce of equity, take full control and continue to build the business. I would probably categorize that as like the turtle, right? And then like your like hyper growth, fuel the business with more and more capital, with like, outside money, or asymmetric outside money. That's kind of like the hare. And I think a lot of it is just, personal preference, right? I think there's no one way to attack the problem. And I think it's more as an entrepreneur, as a business, what are your personal values? What are your personal mission? Like, what do you want to accomplish in life? Like, do you want to make a lot of money really quickly? Well, it isn't going to happen when you got $40,000 in your pocket and you're trying to like bootstrap a company and grow it into, I don't know, like $20 million in revenue in 3 years. Like, it just doesn't happen. I mean, like when it does, it's like, oh, that's the book that's a New York Times bestseller, right? And then, if you're comfortable with like a longer tail, where you're methodically growing, that can happen as well. But like, I think the real thing to look inside is, like what you want to do, what are the missions and values of your company, and, how you want to grow it. I will say that, for us, we constantly have this debate. So it's not necessarily like, a right or wrong thing. Like, I wish I could say like I'm firmly in one camp and I'm firmly in the other. There's so many pros and cons between the two. And, I think one of the biggest things that like I always think about is team. So, it goes without saying, like going at a business completely alone when you are not supremely good at everything absolutely sucks, right? Like, when you have a well-rounded team where, I'm like an extreme extrovert, my partner is an introvert, right? And so when we, not that that has anything to do with business, but like I think we grew in that particular domain. And so he listens very well, I present very well. And so when we go out in the market, we're very well balanced within the context of like who we are as people and how we engage. And, some people like his style, some people like my style, right? Then you go into like level 2 skill sets. Like he is a construction expert. Like he's built thousands of homes all over the world. And, for me, we lead a prop tech firm that serves home insurance companies that analyzes home assessments, right? So, I look at that from a partner perspective, obviously, but then I look at that also within the context of like, well, who's investing in my company? And so like, looking for partners that, as an example, like if you really have a problem with go-to-market, and you're just like, man, I really don't know how to build a sales and marketing machine. Like finding a partner in the market that can help you do that has skin in the game is probably going to be very beneficial to you.
Yeah. Yeah.
So
Good
like
advice.
the constant things that we weigh, as we kind of go through the various stages of our journey, we have a lot of different advisors that are a part of our journey. And then figuring out, well, like, in order to grow methodically, in order to protect our business, our IP, among other things, like what do we need in this business? And potentially like an investor could actually help that out significantly. And so that's kind of the thing that I always use as an arbiter for, well, what are we missing in the business and how can we fill it?
All right. Thanks for those comments. Paul, I was going to ask any good questions pop up in the chat that you wanted to introduce.
We just have one question that popped up right here. Joffrey asks, as an entrepreneur, we love our freedom, but how do we balance that ask or that request for funding? And there's a fear of losing creativity or autonomy to really take the company to that next level. Maybe talk about that in that first stage, about how much you would raise to maintain that autonomy and control that you want.
Okay. Abhi, do you want to take a swat at that?
Sure. VCs are people, and you have to do due diligence too. In the beginning, you won't have the leverage, and it's kind of whatever they say. But if you are a second-time founder who's done this before, and it can get very personal, right? This is a marriage. So when they try to get to know you, and we talk about freedom, it could get political. It could get, personal preferences. It could even get, there's so many hyperboles, right? They're people. And what's interesting is when you do due diligence on them, in the beginning, you're going to look at them as a big fat check, right? That's how I looked at them. But later, I looked at them as, wow, these are the people that might be able to dictate how I run my culture, my company, who I pick up, the decisions I make. And it gets difficult. So now I'm a little bit more deliberate. And as you get more revenue and profit based, as my contemporaries just said, you get more leverage to combat some of the stuff that you don't want on your cap table. So if you're going to go about it, obviously it's kind of like dating. You're trying to figure out if they're a good fit for you. In the beginning, you want to have leverage, but try to figure out how to get leverage. But at the end of the day, if someone's really cool and they want to work with you, you'll find like-minded people, and usually those are the people that fund you. Sometimes people come up on your cap table that you guys might not agree on a personal level, but hey, that's what makes all of this fun, right? So I would really look at it as you're doing due diligence on them to figure out if some of the personal freedoms and some of the stuff that you take for granted or might not take for granted as an entrepreneur is a fit with a VC.
That's a really good point too on the bootstrapping piece and going to market with leverage. One of the things I noticed right off the bat, right? I mentioned earlier in the conversation, our first institutional round, the seed round, was 5 years into our company, and was just raised the last couple of months. We tried to raise venture capital a year or two before that, unsuccessful. I noticed an extreme difference in the amount of leverage I had, and also how the conversation just kind of flowed with investors. A year and a half later, when we grew immensely over that year and a half, and we had the metrics to back up, everything I was saying. And I was saying the same things a couple years before, but you couldn't argue with the data now. So I think by bootstrapping, or, by extending the period of time that you're not taking venture capital, whether you're bringing in some angel money, some friends and family money, we did that too, that I was going to also call out. There's not just one path to start to get capital, but by extending as long as you can the time that you take in VC money, theoretically your company's getting better, stronger, growing every day, and that's going to give you the leverage to be able to have those kind of conversations confidently and make sure that you come out with a good result.
Yeah, fantastic. We often say it's a trade-off between dollars and data, and we always say get the data. And I think that's what you're saying, Sean, is if I get more data, I'm going to get more dollars. I'm going to actually raise more, be in better terms. Good point. Wayman, did you want to comment on that too?
Yeah, the only thing I would add is, I think we've got a mix here of what I'll call small giants. As I read Burlingham's book, as far as firms that want to grow, not become unicorns, but they want to see growth, be profitable, and make a difference in the community versus somebody's unicorn. And as you're talking, to potential investors, partners going through there, hey, what's your plan? And I hate to use a sports analogy, not everyone's going to be a home run grand slam, but if I can go back and show that, and twice in our journey, we've walked away from selling the company to large billion-dollar companies. One's a well-known Fortune 100 firm here locally here, and it wasn't the right fit for us. And I think to have the discipline, no, here's who we are, here's what we want to do, and not yourself, just your investors on board, just saying, hey, I want to take the money and run. And so that's, very crucial, just understanding that. And then the other part is this. Ben Franklin said the only certain thing in life is death and taxes. There's going to be an exit, whether we want it or not. And as soon as you take the money, it's going to happen.
Yep.
How you do that on the best terms, and we're working on that one right now as I start to transition out, look into partial to then go to a full in the time frame, and have the team in place is something that you've got to be talking about. What's that continuity look like? What's that transition that I think a lot of us are so busy, working in the business on the business to talk about or think about.
Yeah, good points. I think people are saying, hey, fit is important, all along the way. And Chin said, team, a big important thing, but part of that team is, of course, that venture capital team. And, how well do you blend with them? And as I mentioned before, 5, 6, 7 year relationship, there's a whole lot that can happen, along the way. Okay. Chin, I was going to kick off the next question with you. How has your funding choice impacted your company's growth trajectory and product development? So, you're in that decision point. You're going, okay, I bootstrap. I've got to get this money. Then what happened right after that?
Yeah. So I think like one of the things that we learned pretty quickly was, you're just not like, doing, oh, it's 2 million, 3 million, 5 million. You got to be very deliberate about what you need to do with that capital, right? So when we, kind of like going back into July 2022, August, when the money hit the bank, like we deployed capital right away. We got to monthly cash burn that we targeted. We were probably off a little bit, but it was very prescriptive in terms of what we wanted to be able to facilitate. From a product perspective, we knew what we had to do, right? We had to scale, components of our artificial intelligence, automated deployment. We had to, scale a lot of our core infrastructure. We had a lot of features that we wanted to build, all planned out for the next 3 to 6 months. We built out our go-to-market team, our digital marketing strategy, and implemented our capabilities. But the point that I am making in this long ramble is, we were very deliberate about like how we use that money. Like it wasn't a week that went by after money hit the bank that we didn't know what we were going to do, right? So kind of coming into the process, I don't know if every VC wants to know every single detail about what you're going to use the money for, but you got to know, right? And so like chasing money for the sake of chasing money and having it in the bank, and oh goodness gracious, right? I'm not building on my $300,000 credit card bill, Wayman. I mean, like that's the kind of stuff that, in my opinion, like you just got to be very deliberate. And if you don't know, like there's no reason you should be out getting funding. Right. And I'm sure there's like externalities in the marketplace, like, oh, you're, Sergey Brin and Sanjay, and you're just like, yeah, we have this web crawler. Like, for every one of them, there's like 1,000 or maybe 10,000 of us. And it's basic principles of business, right? You just got to know how you're going to deploy capital, and it's your number one responsibility is capital allocation. So, do it. And then, I think that's the kind of stuff that, I guess most investors are probably looking for in the market.
Okay, good. Ami, same question. You got the money, and what happened? What was your trajectory after that?
So the stopwatch starts clicking, the time starts, right? So with Bootstrap, it's from my experience, you kind of set the pace, and obviously we're entrepreneurs, so we have urgency. But imagine now that you have the urgency, you have a little bit of rocket fuel, and now it's time to get some proof points on the board. Okay, you raised all this funding, you posted on LinkedIn that you closed the round, and people are going to start checking. And obviously it's up to you to get the metrics for your business, but the people that are going to start checking in have given you hundreds of thousands, if not millions of dollars. And I think Chin brought it up, right? $2 million raised, 2 million ARR. Now you got to get it on the board, but now you do it in a public forum. And unfortunately, a lot of my friends and amazing entrepreneurs they've raised in 2021, and they went bankrupt in the last 7 months. And but the funny thing about the Valley is here you go do that. It's part of your journey. You get to raise more money here. It's very hyperbolic, and how that affects companies. But I think the biggest consideration that people don't look at before they raise venture or after they raise venture is the time starts, and really there's more people checking in on the time and the metrics of your business. But that's what's great, and many of my contemporaries on this panel brought it up. If you were a bootstrap founder, you already know how to get profitable. You already know how to sell. You're already profitable focused. So you're better in managing that time. And when someone does check in, they're like, all right, man, let's check what you did. You're like, oh, no problem here. This is what we've sold. So yeah, I think the clock starts ticking, and that's something that people don't recognize.
So that additional pressure. Paul, did we have any other questions pop up?
No, I think to tag on to that, I think what would be the ideal runway that you would want to extract from that raise, and then we could roll into after that. Abhi, you kind of touched on it. Finding the right partners or your fractional perspective or consultants. How do you juggle all of these variables to be able to get to that next level where you might raise a future round?
Okay, Sean, you want to take a shot at that?
Yeah, sure. Before I answer that question directly, Paul, one of the things that I do think is important to call out, I'm sure most folks are already aware of this, but there's a big trade-off too that we haven't spoken about when you do decide to go after, venture dollars or just fundraising in general. It could be angels as well. As that time is going to be spent every day fundraising versus spending with customers and building the business. So, you got to imagine average fundraise, at least for a VC round, is anywhere between, I think I saw the last stats from Carta, like 4 to 12 months in that time frame. So that's going to be 4 to 12 months of you not being in the day-to-day of the business operating, which again, if you have a strong founding team and you feel like the time is now, it's probably makes sense. But if you don't, you're going to be losing all that time that you could have invested in building the company. To answer your question directly on kind of runway, so it at least used to be the rule of thumb that I always learned from my founder network was you want to make sure that you have at least 18 to 24 months of runway, and then probably from that capital that you raised, and then add on a little buffer. I like to think of it in my head a little bit more conservatively, and I think the market's gotten tougher to be able to raise. So that number, I think, is probably much higher. It's probably around like 36 months at the very least. But I don't even get caught up too much in that, because my mindset is whenever we take in capital, act like this is the last money you're ever going to get. So we got to make it work. And we got to get the profitability again, by investing in growth.
Yeah, good advice. Wayman, I actually answer the same question, but I know you work a lot with Department of Defense, government contracting, and I don't know if that changes the landscape at all.
Well, our sales cycle is 18 months to 2 years. So I think one of the things that doesn't change here, and that it is unanimous going across, is that sense of urgency. The fact is, even when we have the funding, we can never get comfortable and complacent. And and I look at Chin, Avi, and Sean. Hey, I'm Social Security eligible. The end is closer than the beginning for me. And knowing that, hey, if you're trying to make a difference, we're not talking valuation. We're talking what are we doing for our client? What are we doing for our team to get better? And saying finish strong. I think that's what comes through when I'm inspired listening to the folks here is we can never take it for granted. And that we know that there's no guarantees. And as we talk that competition, we're trying to get better like everybody here. What are you doing? And who are those partners that we're going to go have to do? And if you're not waking up every morning thinking that, you're not going to go ahead and succeed. And, and that for whatever business or wherever you are, and I'm inspired to hear as far as in this market here, guys talking about being as far as unicorns. And I wish everybody the best here. And I learned from participating in this. So thanks for inviting me. And the one thing that we're good about as far as on that in our business, while it might be a slow sales cycle, you're going to get paid. And there is a long tail to those contracts. And so you've got to balance in there that pipeline on which projects are going to give you that recurring revenue with the predictable profits, and which ones are going to give you a innovative technology that you can scale and try to commercialize. And we have to balance in between that with everything else going on.
Yeah, very good point. There are some people with a very short sales cycle, but the ones typically B2B much longer. So I get the money and you go, oh my gosh, how am I going to get the contracts lined up and sync so I can start returning money? Okay, good. Chin, I'm going to ask you the next question. And what we're looking at is the funding landscapes. I know you're founded in 2021, certain landscape there, just right off of COVID. But how's that landscape changed right now, the funding? What have you seen in just the last 3-4 years? I know we've seen it as we've worked with founders, but just curious what you've seen.
Well, so kind of like a little bit of a history lesson. I think, low rates, a lot of committed capital raised by VCs. You probably 4 years ago heard this phrase a ton: dry powder everywhere. I don't think you hear that much now. But things have changed, right? Like rates have obviously, rate dynamics have changed. Hopefully the Fed decreases rates, but it's still generally pretty high. And so a lot of that dry powder has, roughly been deployed. I think from like what interests capital, I think if you had an AI story in like the early stages of like the ChatGPT launch, I forgot what it was, like November 2022 or something like that, man, like everybody wanted to talk to you. If you have an AI story, everybody probably doesn't want to talk to you now for some weird reason. Look, I think the fundamentals haven't necessarily changed that much. Like I would say, like when it comes to a business, high growth and proven high growth is actually like still a very awesome and important story. But as we kind of went through, at least for us, like that kind of like 2021, 2022 period, and now today, like there's like an intersection, which is high growth and capital efficiency. And then like if I was, coaching, any entrepreneur, I'd probably echo what Sean says around profitability, right? Like the best FU money in business is monthly free cash flow positivity, consistent, right? And so if you have that, then you're able to dial up or dial down your business. And if you have a level of like prescriptive knowledge about what's going to happen in the future, granted, like nobody ever has a crystal ball, but you run a business, you have a track record, where things are trajecting, knowing how things are going to grow naturally within the markets that you serve is incredibly important to make, operative decisions around investing and what you're going to do with that capital, right? Like Wayman's comment around like, yep, long sales cycles, guaranteed payment, like he knows his market ridiculously well. And so should you. And so when I see a question on there by Fatin, like what are the modalities to make investment decisions? I think from my perspective, one of the most important things is like, you got to know your market and know where your money's going to come from, at least have a really, really good understanding of that. And so like looking at the investment landscape, like I think those fundamentals still hold true. And so just as a recap, right, like you still got to grow and you need a plan to grow, you need a track record to grow, but now this capital efficiency component, like make sure you nail that intersection really well. And I think you're still going to have a lot of opportunities to entertain investments.
Okay, thanks. Abhi, your perspective on that, how things changed. You're in a different vertical, working with different clients. What have you seen?
Yeah, what's interesting is, we obviously have an AI element. We're obviously in climate tech. Climate tech perspective is everyone's worried about November 5th, no matter where you lean, and we don't want to get political here, but I think it's very good when you're considering climate tech that you are a business that will survive no matter what happens. And I think people forget that, especially young entrepreneurs. So if you're, as my contemporary said, if you're profit focused, if you know how to sell to customers, you're fine no matter what. But this is something that came up just yesterday. I was on a climate panel, and a lot of younger entrepreneurs like me, we've raised a little bit of funding, and we're leaning on, the government or someone else to see what happens with our business. And look, that just does not work. I mean, you got to be able to survive no matter what. And when I said that on the panel, I think I became public enemy number one on that panel, which is fine. But in my specific, in climate tech, I'm in prop tech, we're industrial space. The data center industry is growing. It's not stopping it no matter what. So we had to become experts in our own space to when VCs start doing diligence on us, they realize, hey, they're coming to us to learn a little bit more because we're on the front lines. Because we know we're on the front lines because we're speaking to customers every single day. So I think that what makes the difference in your industry, whether in specific, and maybe that's not the best metric if you're going to raise follow-on funding or not, is, hey, do you know the industry better than the VCs doing diligence? Are you a thought leader that can make insights? And the only way you can know those two things, thought leadership and know the industry, is if you're speaking to customers every single day and on the front lines. So that's something that we had to really make sure that we do well.
All right. Thanks, Avi. I want to do a quick lightning round with everybody, all four panelists, on what advice would you give to early entrepreneurs, obviously on the subject of bootstrapping versus venture capital, and then we'll open it up for any Q&A because we got about 10 minutes left. All right, Sean, why don't you start us off? What's your best advice to these startups?
Push off VC funding as long as you can. There's ways to take in capital investment besides VCs. I don't want to cast the message that you shouldn't take venture funding. Just push it off for as long as you can because of the advantages that we all spoke about in this panel today.
Okay, good. Thanks, Wayman.
Marry well or have a significant other partner who understands what you're getting into. I'll tell you two stories. One is, when my wife, we had our first child, and she'd supported me on the business where I wasn't getting paid. And our first child was born. She was going to stay on for 6 months. I said, sweetheart, I need you to go back to work. 6 weeks after, I'm not getting paid. I got a job I love. I need you to. She said, absolutely. She didn't go look for a job. I went and found her one. The things we do to keep our business going. When I had accumulated that $322K of debt, and we're starting to grow out, and I went to her and I apologized for borrowing against the house, getting it all in debt. And I said, honey, here's the good news. The good news is it's in my name. That's right. You can apply for credit and we can rebuild. And she did. Having the right partner makes a difference.
Good advice. Thank you. Chin, what's your advice? Marital or not?
Yeah, I was definitely blessed with a very understanding wife, myself, Wayman. So for me, I think we need to have like as much confidence and ego to be able to go out and conquer the world. But I think self-reflection is really key, and understanding what are your strengths and what are your weaknesses. And I think weaknesses don't necessarily need to be something that you alone need to Superman through, right? There are people in this market all around you that are insanely good at things that you are weak in, and finding those resources, whether if it's, founding partner, people that you hire, or people that participate in your cap table, that's the thing that will ultimately help you become successful, whether if you're doing the turtle and working a long tail and taking your good time to basically get there, or you want to aggressively attack it like the hare. That would be my advice.
Okay, thanks. And Avi?
Yeah, I guess, this 99% of people will fail in this, and maybe I will too, but it's good that we kind of talk about it and we don't shy away from it. If you want to build a unicorn, in all considerations of what that is, if that's the right fit for you, and a lot of people will fail, pick your investors wisely, because sometimes even investors that you pick might not be able to help you build that unicorn. You see, they always do diligence on you, but you got to do diligence on them if this partner is going to be able to help you create $1 billion valuation company.
Okay, Thanks, Abby. Paul, any Q&As in there?
No, just to follow on to that question,
Yeah, please.
have any of you turned down opportunities for capital?
Yes.
Yes.
And maybe just 2 seconds on why that wasn't the right fit, or what to look for a little deeper.
What? Yeah, why'd you turn down, Sean?
There's a couple scenarios, one of which round was, so our VC that our first VC investor that we raised the 3 million from, put in the full 3 million. Additional VC smaller checks wanted to come in on top of the 3 million. We didn't want to take in additional capital on top of that. So that was one of the scenarios. Other scenarios, just we spoke about earlier, and I totally agree. My counterparts here on doing due diligence on the fund, on the specific partner in the fund that's investing in you. I just didn't get the warm and fuzzy vibes that I preferred to get, knowing this was going to be a 10-year relationship. And again, if you bootstrap and ideally get the profitability, you have a little bit of the pressure off where you're not forced to take capital from anyone.
Good. Wayman, you said you had all.
Yeah, we besides the 2 deals we walked away where we had whatever intents, we're in a space in defense that's countercyclical. So right now, while traditional money is going down, private equity, there's not a week that we don't have several going through there. And I think just to echo on Sean, is find the right one who understands that you want to partner. And it's not just, as I said, the money on the valuation, it's the culture, how they treat the team, how are they going to come in, partial versus full. What do their board look like? How are they going to align on that? So it's a long-term dating process. And then you've got to be ready for that season. Say, hey, I'm ready to come back. I think we talked earlier here, when you realize, there's a great book out there as you grow called No Man's Land, the 4 M's, money, market, model, but the most important is manage. The people you have with you now, can they take you to that next level? And I think that's where you're bringing a partner is going to help you bring some seasoned folks in and augment that will take you that next level. Because let's face it, as we talked here, the odds of failure are extremely high, and those key hires are the difference between success and failure going forward. So that's what we look for going forward.
Okay, thank you. Paul, any other questions come up?
I'd just like to call out, Abby, thanks for the dilution expectation. If you're early stage and you want to understand a little bit more about that, I can bring this back down to the bottom. But earlier in the conversation, Abby shared this resource.
Okay. All right. Well, thanks. David, did you have any comments you wanted to make just as we're wrapping up here?
No, but I really do appreciate the transparency of all the speakers. I mean, starting a business is not easy. Running a business is incredibly difficult. Exiting a business is less than 1%. I mean, so it's a long journey, and nothing makes you more humble than going broke to build your business up and work harder every single day. So I really appreciate Abby, Sean, Wayman, and certainly Bob and Paul for leading us today. So thank you so much.
Yeah. Thank you. I want to thank all the panelists for making time to get together and share it. And I'll echo what David said. You've been very open and honest about it. What are your pain points? So thank you very much for sharing all that, and for everybody that joined in. Thanks for joining in and giving up an hour of your day. I really appreciate it.